Welcome back. We are speaking with Beata Caranci, Chief Economist at TD. We've been talking about SVB and just the overall impact on the U.S. economy. Just a tilt back to Canada. I guess the Bank of Canada, which paused, is actually maybe looking a little more prescient maybe, yes. But in terms of their choices. But does this change anything in terms of the ramp, the where we're going, or any of the issues that the Canadian economy is dealing with?
Yeah, it's interesting because the Bank of Canada paused in order to monitor the lag effects of the rate hikes on the economy, which some might argue maybe the Fed should have done.
Yeah, the speed was the issue, maybe that's, yeah.
Exactly. So certainly from the Bank of Canada's perspective, this is one of the things they would be monitoring. This would fall into the checklist of market stability. For the economy itself, what's interesting is in their last meeting, they had talked about much tighter financial conditions. So even though they indicated a pause in January, we had seen yields rise quite substantially, about 80 basis points, since that pause, because it was riding the wave in the US. Now it's riding the wave coming down, and we've seen yields retrace. So they still have to have this in high consideration, because if they felt that some of the financial tightening was coming from the US, well, we've now just seen some loosening coming through on the yields side in Canada, and we certainly don't embed the banking risks that they have in the US. So it's not the same degree of financial tightening from the credit side that you see in the US as you're adopting here in Canada. So it'll be something they monitor as they go forward, but ultimately at the end of the day, it's what affects the real economy. And for this degree of financial market stability to really affect the real economy, it generally has to persist well over a month. You need it to continue to be in this tumultuous situation where it gets to the point where it starts to undermine business confidence, household confidence, investment intentions, and then eventually hiring intentions. So it has to have longevity to it. So we've only been a few days into it, and we've seen a lot of backstops put in by the FDIC in the US, the Federal Reserve, the Treasury. So we'll see how the dust settles on that. It already looks like it's having a little bit of a calming effect. And as long as this doesn't persist into a month or two, they would just treat this as a one-off aberration.
And I guess the other thing too is, I would expect you're going to be watching inflation data. I mean, if things loosening, you could see inflation start to, solidify at current levels instead of dropping or even moving up. I mean, is that a danger as well too?
Yeah, that's what Carolyn Rogers had mentioned, the senior deputy governor, that there is a possibility we can get this, reignition of inflation. Now, her references were more in relation to the strengthening global outlook.
Right.
So China in particular, Europe doing a bit better, and that this could put a firmer commodity base under us. But certainly if people are thinking, oh, yields are dropping, and that's getting transmitted to mortgage rates or other lending products, and they start to get back into the spending mode, then the Bank of Canada that pause is not going to last that long. They would have to react to that. So I think we're just going to have to just play it by ear in terms of how sustainable the drop in yields is, because as we saw today, there was a very swift backup of about 30 basis points just on a single piece of data.
Yeah, no, it's quite remarkable to watch those markets move. I need to ask about, you mentioned about the job market, just everything, how it transmits to the labor market, but it's still pretty toasty, pretty hot.
Yeah, like it is in the sense that we got a normal employment report last week, meaning just over 20,000 jobs, and that would be normal if this was a normal situation in terms of the pace of job growth, but the prior 2 months created over 200,000 jobs, which is normally what you create over an entire year. So we don't want normal anymore. Yeah. You actually need it to calm down quite a bit more. The good news is we didn't get another print of 150,000. The bad news is it's not showing the degree of softness that would pretty much give the Bank of Canada comfort that inflation will continue to trend down on a more sustainable basis. I will say this on the job market, there are some little cracks starting to show within the private sector. There were sectors like professional and finance sector that had seen job losses for 2 months in a row. Where we saw the job gains in the most recent months are actually coming of what we define as non-cyclical sectors of the economy. So these would be the public sector, health, education, and utilities. And they are accounting for the bulk of the job gains that we're now seeing, which means it may not actually, we actually may be seeing a little bit of private sector fatigue coming through, but it's getting masked by the side of the economy that's not responsive to interest rates.
Right.
So I think if we see that a couple more months, that would be encouraging data for the Bank of Canada that we won't get this wage push type inflation persisting.
Great talking to you as always. Thank you for being a beacon of reason and light in some of the turmoil right now, Beata. Thank you.
My pleasure.
That is Beata Caranci, Chief Economist at TD. All right, stay with us. We're going to be talking about the big bank earnings. Some beat estimates, one didn't. Mario Mendonca, Managing Director at TD Cowen, goes over the results with us. You're watching Money Talk. We'll be right back.